All right, we're going to go ahead and get started. So hello, this is Chad Duvall, the National Practice Leader of the Communications Media Practice at Moss Adams. I want to welcome you to part 2 of our 3-part virtual workshop titled Your USF Reform Questions Answered. As we did yesterday, I have a few administrative items I want to cover before we get started with the webcast. First, this webcast series is designed as a primer for our management conference that's scheduled for May 3rd and 4th in Las Vegas. We'll provide a detailed summary of the order there, including an analysis and financial regulatory impacts of the order. We'll provide complete reactions to the order in the further notice of proposed rulemaking. That'll include some discussions of how to strategically react to the order. And sort of most importantly, it'll be a highly interactive session that should allow you to discuss some company-specific issues with Moss Adams consultants and accountants and your peers from throughout the industry. We highly encourage you to attend and to bring the FCC's USF reform into focus for you and your company. Information on registering for the management conference can be found in a variety of places. I'll go through most of them here. First, we sent out an invitation for the management conference. There is a link on the invitation to this webcast series. During the introductory slides during this webcast series, the registration information is being provided there. And you can also go to the Moss Adams website at www.mossadams.com. And finally, feel free to contact any of the folks you work with at Moss Adams, and we'll make sure to provide you the registration information that you need. Secondly, all the webcasts in this series are being recorded and will be available within 7 days. Actually, they're usually available much earlier than that, but just being careful to give us a little bit of time to put it together. So those are available in case you'd like to listen again, or if any of your colleagues are not able to make today's webcast, please let them know it is available recorded. I do want to remind you all that we are having some issues with the mute function, so please mute your lines. We hear some background noise, so please mute your lines. Thirdly, we'll attempt to answer as many questions as we can throughout the webcast and ask that you use the Q&A function in WebEx to submit any questions that you have. Don't send private emails or private chats to any of the participants in the webcast because we just won't get that. So thank you. We also encourage you to reach out to any of the presenters on today's webcast or any contact that you work with from Moss Adams with any additional questions that you may have. And we'll get back to you as soon as we possibly can. Fourth and finally, as always, today's session is eligible for continuing professional education. Each webcast this week is eligible for 2 hours of CPE. If you'd like that CPE, please make sure that you respond to the CPE polling questions that we ask throughout the presentation. You're required to respond to 6 of the 8 questions in order to be eligible for the CPE. And that CPE certificate will be mailed to you within 2 weeks to the email address that you provided upon sign-in or registration for today. So as we did yesterday, I'll be the primary presenter today, but we'll be joined with additional commentary from Stuart Polikoff, R.J. Delmise, and Tim Rutkowski. A couple of them were on yesterday's webcast and provided some great commentary and questions and answers at that point. So looking forward to their input on today's webcast as well. These guys know their stuff and will provide some insightful questions and answers throughout the webcast. So now that we have the administrative side of things taken care of, let's go ahead and get things started again. Okay, so we always have to start with a disclaimer. And so as all consultants and accountants typically do, we'll take credit for anything we say today, but not any of the blame. So on that note, we're going to go ahead and get a couple of our CPE polling questions out of the way so that we don't have to waste time once we're in the midst of the material. So if we could bring up the first couple of polling questions, I would appreciate it. We're going to do 2 at a time here to keep things simple and not to waste any time. So the first question is, I plan to attend the Moss Adams Management Conference on May 3rd and 4th in Las Vegas, which will dig deep into the impacts of the USF reform order. All right, so hopefully the answer to that is true. And secondly, my company has or will perform a detailed analysis of the impacts of the FCC's USF reform order. And again, we hope that that answer is true. There's a lot of changes going on here as a result of this USF reform order. We really encourage folks to make sure that they're doing a detailed analysis of that, of these changes, of the implications of this order, so that you know what your future may well look like under this under these revised support mechanisms. All right, so let's go ahead and get started with the fun part here. So today we're really going to focus in on the reforms of the existing rate of return carrier support mechanism. So we're really going to look at changes to interstate common line support and how we get cost recovery for data-only broadband loop-related costs. All right, so I want to start with that support for broadband-only loop costs. And something important to start out with is some definitional items. The FCC is sort of redefining items that we know today and providing some new definitions going forward. So starting with support for broadband-only loop costs, first thing that's important to understand is we've got a new support mechanism. ICLS, as we know it, is going away in the sense that the name is going away. The costs and the cost recovery isn't necessarily going away. So they're renaming ICLS the Connect America Fund Broadband Loop Support, or CAF-BLS, or even shorter, BLS. So the CAF Broadband Loop Support includes both common line, so common line costs as we know them today, as recovered through interstate common line support, and something that we'll start referring to as consumer broadband only loop costs. And so this support mechanism is now going to support voice in broadband, and broadband only services. In the past, ICLS only supported local loops that provided voice service, so it included voice and voice in broadband services. So broadband loop support is really going to treat all loops the same, regardless of the service provided over them. However, high-cost loop support remains effective only for lines with voice service on them. So high-cost loop support, as we know it, continues going forward. No real changes there. And so it just continues doing what it's done for the last however many years. So then we want to define what the consumer broadband-only loop is. A consumer broadband-only loop is a line that's provided to a customer without regulated local exchange voice service that's used then with the provision of fixed broadband internet access. So another way of thinking about this is to define it as services we've previously referred to as data-only broadband, or standalone DSL, or naked DSL. However, it's important to understand that broadband loop support only supports the loop cost that is not currently supported through high-cost loop support, or ICLS. So we'll get into the details of that here in just a little bit. But just from a definitional standpoint, what we're talking about is data-only broadband services. All right. So we're going to start with figuring out what costs are to be recovered, what costs fall into this broadband-only loop component. So consumer broadband-only loop revenue requirement is a new revenue requirement and new rate element implemented in Part 69 of the FCC's rules. And so what we're looking at is loop costs that are associated with that broadband-only service, which for voice services, so from a comparability standpoint, it's those costs that for voice services are recoverable via ICLS. So how do we define, or how do we figure out what the consumer broadband-only loop costs are? Well, it's a fairly straightforward process. I'll say it's sort of an estimated allocation, if you will. So we're going to start by looking at common line investments and expenses. We're going to take 100% of that common line investment. For ICLS purposes, we only assign 25% of that common line loop cost of the interstate jurisdiction. The remaining 75% goes to the intrastate jurisdiction. But for purposes of defining our consumer broadband only loop cost, we're going to start with 100% of the common line investment, so the amount that's assigned to interstate as well as intrastate. We're going to do the same thing on the expense side, so a real easy parallel. Investment and expenses are treated the same. So then what we're going to do is we're going to take that 100% of our common line investment and divide it by the number of voice and data lines that a company has to produce an average investment or expense on a per line basis. So we're looking at common line costs associated with voice divided by lines that include voice. So it's not taking into account any broadband-only specific costs or broadband-only specific lines. So we come up with an average common line cost per voice line. We're then going to take that average common line cost per voice line and multiply it by the number of consumer broadband-only loops, data-only broadband, if you will, lines that we have. And that's going to provide us with an amount of investment or expense that's going to be shifted from our special access rate element over to the new consumer broadband only loop revenue requirement and rate element. So again, it's an estimated allocation. We're looking at our average cost per loop for voice services, and we're applying that same average cost per loop to data-only broadband, or I'm sorry, I need to start using this new term, consumer broadband-only loop cost. Very consistent with how we're assigning that data-only broadband cost to special access today. Essentially, we're reversing that allocation and bringing it now into this new revenue requirement. So that amount must be removed from special access to avoid double recovery. If we left it over in double recovery and then assigned costs to consumer broadband only loop cost, we'd have a duplication of those same costs. So just like anywhere else, we've got to make sure that we're avoiding double recovery. And today we certify that we have no double recovery or that we've reflected the double recovery in the calculation of our CAF ICC support. We have to do the same thing here with broadband only loop costs and certify that we have no double recovery. So on that note, we're going to bring up our polling question number 3, get a few more of these out of the way if we possibly can. So the question is, with the implementation of broadband loop support, interstate common line support will cease to exist as a standalone support mechanism. True or false? Okay. So the answer is, I'll say obviously true. ICLS as we know it today goes away in name. In concept, it's really built into this broadband loop support. We still have the same common line costs. We still have the same calculation essentially of cost recovery. I'll get into the details here in a bit of how broadband loop support is calculated, but it really takes that ICLS calculation as we know it and layers on the broadband loop support, or I'm sorry, the broadband loop costs as well as the broadband loop revenues. All right, so speaking of those consumer broadband loop revenues, we have now the introduction of a benchmark rate. We've talked about this benchmark rate for a long time, so this should be nothing new to folks. So the consumer broadband loop revenue that we'll generate is the lesser of two things, with one exception. I'll get to the exception here in a minute. But in most cases, it's going to start out as the lesser of a benchmark rate that's established at $42. So if you think about that from an annual standpoint, $42 is a monthly benchmark. $42 times 12, if my math is right, is approximately $504 a year. So we have a benchmark rate of $504 a year, and so then we'll compare that to our consumer broadband only loop revenue requirement per loop. So if my cost per loop is actually less than $42, then my benchmark rate for my company, this is company specific, is going to be that lesser amount. If my consumer broadband only loop revenue requirement per loop is greater than $42, then I apply the benchmark rate of $42. One thing that I wanted to note for folks is that just thinking about $42 as a benchmark rate at $504 a year, if we compare that to the benchmark rate that we use for high-cost loop support, it's our national average cost per loop, which is currently frozen at approximately $650 a year. So the loop cost benchmark for consumer broadband only services is actually less than our benchmark rate for high-cost loop support. So here's the exception to that $42 or the lower of the consumer broadband only loop revenue requirement per loop, is that if the FCC applies a budgetary constraint, so meaning that there's not enough support available to cover all of these costs, then the FCC has to apply a budgetary constraint. They have to limit the amount of support received so that we don't exceed that overall budget. So if a budgetary constraint is required and there's not enough support to cover all costs above $42, then a company's consumer broadband loop revenue can exceed that $42 benchmark. And what that really means is that we can tariff a rate that's higher than the $42 if there's a budget constraint, so that we can make sure that we recover all of our costs associated with the provision of consumer broadband only services. So speaking of tariffing, this rate can be tariffed or de-tariffed. Think of it as very comparable or similar to DSL transmission service that would still regulated but can be offered on a tariffed or de-tariffed basis. So here's an interesting twist, and this is something that's I think really cool from a lot of people's perspectives, is that if that benchmark rate is tariffed, we have to assign the or assess the federal universal service charge. So it's a contributor from a USF perspective. However, if that service is de-tariffed, there's no application or no assessment of the federal universal service charge. My belief is that this will lead most companies to choose to de-tariff that. If you think about the current rate, and I'm just going to keep the math simple, of approximately a 20% assessment of the federal universal service charge with a $42 benchmark, you know, we're talking about some pretty significant contributions, somewhere in the range of $8 per line per month, that if we de-tariff the service, we wouldn't have to assess that $8 federal universal service charge. So just like with DSL transmission service, if we're going to de-tariff that service, this consumer broadband loop revenue benchmark, if we're going to de-tariff that, those costs have to be calculated. The costs associated with consumer broadband loop services have to be calculated and removed from cost recovery. Essentially what we're saying is that Part 69 revenue requirement that we just talked about calculating, we have to take that revenue requirement and say, hey, it's not included in our NECA settlements. It's not included in that whole process. So, and then just a clarifying point. We talked about ACAM yesterday in a tremendous amount of detail and what it takes to elect the ACAM and so on. So for any carriers that opt into the ACAM, this $42 benchmark is allowed. They can tariff it or de-tariff it. They can charge it to end-user customers, but it is not required. When I say end-user customers, for the most part, my vision is that this charge will be assessed to ISPs that will then flow it through to their retail customers. So it can be charged, but does not have to be charged. Okay, so some CAF ICC considerations that come into play. So as we now start providing support for consumer broadband-only loop costs, which has not been supported in the past, which is one of the reasons why the NECA wholesale tariff rates for data-only broadband services are much higher than the voice and data rates, because there's a component of the service for broadband only that's not supported, whereas if there was voice on the line, those costs would be supported. So we're going to see, or envision that we'll see, some level of migration of customers from services that include voice to a broadband-only service. The result of that transition is going to be a reduction in the number of ARC, or Access Recovery Charge, eligible lines, and the associated eligible recovery that comes from the assessment of that ARC. The ARC that we receive reduces the amount of CAF ICC support that a company is going to receive. So the FCC is concerned here that, hey, if we reduce the number of ARC eligible lines, then CAF ICC support is going to somewhat shoot through the roof here, and they don't want that to be the case. So companies are required to impute, not allowed to charge, but required to impute the ARC charge on consumer broadband-only lines. So essentially, companies have to eat that. Sort of see this as strictly a budgetary issue. Without the ARC, as I mentioned before, that CAF ICC is going to increase, and unfortunately, the FCC is not allowed for any additional budget to cover that cost. So I sort of think of this as an additive to that benchmark total. So we have a $42 benchmark, and then we have a $3 ARC that we currently assess today. So we can sort of look at that as a $45 benchmark rate for consumer consumer broadband only loop costs. It's going to take me a while to get used to saying consumer broadband only. It just doesn't flow off the tongue. So one question I want to ask Stuart, if he can here, is that this comment about the imputation of that ARC charge on consumer broadband only lines, my read and understanding is that that has to be imputed, but cannot be charged to broadband-only customers. Stuart, do you have any additional insight on that? Is that correct, that it has to be imputed and cannot be charged, or can it be imputed or charged?
I think your interpretation is correct, that it's not something that can be charged, at least not as a separate line item that says ARC, that it has to be imputed. Like you said, carriers have to eat it.
Right. Yeah, and so my only question there, and I'm not 100% sure on this, is that if for some reason that could then be used in increasing the benchmark rate from $42 to presumably $45. So not sure the right answer there, but certainly we'll continue looking into that and make sure that we get to the right answer.
Well, I think certainly, I was just going to say, certainly a carrier can recover it through, assuming they have headroom, and I imagine they would, just through their retail, broadband rates.
True, right, because they're incurring the cost, and so
that's right. But But I guess the bottom line is, ARC stands for Access Recovery Charge, and now there's no longer access, and so you can't charge a customer an ARC for a line that has no access on it.
Right.
And I have one question that clients might be considering is, will they have to track business versus single-line business versus residential data-only customers for that imputation of the ARC? Since at least for the next year, the maximum ARC would be $250 for a residential and a single-line business, and until they get to $3 in parity, will you need to have to identify those individually?
I believe the answer is yes, Tim, and we'll talk a little bit later about sort of the reporting requirements, and there are line count reports required that'll require companies to split out their services by residential, single-line business, multi-line business, and so on. So I think we'll sort of get to that here in a little bit. So then the next issue related to CAF ICC is that the assumption is that switched access revenues will also decline as lines convert from including voice services to only having broadband. The amount of access revenue generated by those lines is going to decline somewhat. I would guess not real significantly. It may in some cases, but I would assume that many customers that have a voice line today that are going to convert over to broadband only, maybe ones that are currently bypassing the public switch telephone network anyway, but that's an assumption. So, but that's the FCC's assumption is that those switched access revenues will potentially be replaced by some special access revenues. My guess is what the FCC is thinking here is that as more customers convert over to broadband-only services, that the ISP's pipe, their middle mile pipe, will have to increase, get bigger to carry that additional demand and to include some voice over IP calling. And so I think their presumption is that ISPs are going to order bigger pipes from the ILEC. And so what they've indicated is that carriers must report additional special access revenues as double recovery. But my understanding and my read is that these additional special access revenues are directly associated with that transition from voice services to broadband-only services. So what I see this as is special access revenues associated with increased bandwidth purchased by the ISPs, and I don't believe it has anything to do with additional circuits that could be ordered by carriers or end users of traditional special access circuits. I believe that's the case, but I think we're going to have to get some additional clarification there. Stuart, I don't know if you've got any additional thoughts or any read on that, but that's sort of my initial interpretation.
No, nothing additional.
Okay, great, thanks. All right, we've got some questions coming in. I'm going to get through a couple of more slides here, and then we'll come back to the questions that are coming in, so please keep them rolling in. So I want to talk a little bit now about the calculation of the Connect America Fund broadband loop support stream. So you're going to recognize this. It looks pretty familiar, very similar to ICLS as we know it today, which is we look at our interstate common line revenue requirement, we subtract out our subscriber line charge revenue, we subtract out our special access surcharge revenues, we subtract out our line port costs, and that's what our ICLS is today. So now let's step back and say, okay, how do we calculate broadband loop support? Same situation. We take our ICLS revenue requirement plus now our consumer broadband only revenue requirement, less our subscriber line charge revenues, less our consumer broadband only revenues, which we just defined as basically that benchmark rate, primarily $42, or in most cases $42, less our special access surcharge revenues, less our line port cost. The remainder is the amount of CAF broadband loop support that we're eligible for. So essentially they've just bolted broadband loop support onto ICLS and gave it a new name. So nothing terribly unique here. So next we need to talk a little bit about the attribution of that broadband loop support. How does it get applied? So how do we take a limited amount of support, talk here in a bit about the fact that this will be limited and how it's going to be limited. So if we have a limited amount of support that may or may not cover all of our costs, how do we assign that support to the recovery of costs? So first we're going to start by assigning that broadband loop support to interstate common line revenue requirement for the years that are currently being trued up. So it's prior costs that we're currently truing up. So those costs were incurred in the past, it's now 2 years later, and we go through a true-up process. So we've got to make sure that we have broadband loop support to recover those costs that were incurred in the past. The second place that the broadband loop support is assigned is to the consumer broadband only revenue requirement for years currently being trued up. So again, historical costs, making sure that all of those costs are recovered. So we go to prior costs first. If there's enough support left over, then we go to the current year interstate common line revenue requirement, and we make sure that that's fully recovered. And then finally, if there's enough support left over after we've recovered our historical interstate common line revenue requirement, our historical consumer broadband only revenue requirement for years currently being trued up, plus our current interstate common line revenue requirement. Then if there's any support left over, we assign it to the current year consumer broadband only revenue requirement. So if at any point in time, if any point in this process the revenue requirement is not recovered, then our costs are recovered in a couple of different ways. First, it could be recovered through an increase in the consumer broadband only rate. Remember, we talked about the benchmark rate is $42 unless there is a limitation applied to the total amount of support, in which case it can be higher than the $42 and the tariffed or de-tariffed rate could then be higher. So a couple of thoughts here is first, in terms of how do we recover that revenue requirement? How do we recover those costs that are above the amount of broadband loop support that's required? First, you just have to ask yourself the question, do you want to charge more than that $42 for the broadband-only loop service? Again, this gets back to the current situation we're in where data-only broadband rates are higher than our voice and data rates. So we're going to have to ask ourselves the question going forward, do we really want an ongoing disparity in those rates? Not that there may not be a disparity already as a result of the $42 benchmark. And then there's really a tough question as to what if under number 3 here, the interstate common line revenue requirement is not fully covered through broadband loop support? Well, right now we have a cap on our subscriber line charge, and so if our interstate common line revenue requirement is not fully recovered through broadband loop support, the only rate element that's out there and available to recover those costs is the subscriber line charge. So in the further notice of proposed rulemaking to this order, there is some discussion as to whether that SLIC cap should be increased beyond the current $6.50 for residential and single-line business customers and $9.20 for multi-line business customers. So some interesting questions there. All right, we're going to get to polling question number 4 now. And then we'll answer some of the questions that have come in. All right, so true or false, a tough one here. The consumer broadband loop rate is capped at $42. True or false? A little bit of a trick question here. Technically, it's not capped at $42 because if there's not enough support to cover costs above $42, then we could increase the benchmark rate for an individual company beyond that $42. So we've got several questions that have come in here via the Q&A function, and keep those rolling in, please. Start at the top here. Does the consumer broadband-only loop include both residential and business lines? My understanding is that it includes all broadband-only lines, but something certainly worth checking into because sometimes there is a differential between treatment of residential and business services. But my initial read is that it would include both residential and business lines. Stuart or Tim, not sure if you've read it or seen it any other way.
I believe it is both residential and business, as you said. Going back to the same discussion we had regarding the ARC charge imputation, that there would be a differentiation between those two, and a loop is a loop, whether it be business or residential, when you're calculating that broadband-only loop revenue requirement. So I believe that's the way it is.
Okay, great. So the next question is, actually the next couple of questions I think are pretty similar, maybe the exact same question. So if the federal universal service charge is required on this new consumer broadband only service, will it be required on voice and data loops? And so I think that question really gets to, is it required on the local loop component of the voice and data service? And I think the answer there is no. It's only this new data-only broadband loop benchmark rate that Federal Universal Service Charge is applied to. From a DSL transmission perspective, and this really gets to the next question, that Federal Universal Service Charge still applies to that DSL transmission component. And I don't see anything in the order that would differentiate between the Federal Universal Service Charge being assessed regardless of whether the service is tariffed or de-tariffed. So I think that the DSL transmission will continue to be FUSC accessible, but the local loop component here for data-only broadband is only accessible if it's tariffed. So I hope that helps. The next question is, I assume if we are members of the NECA DSL pool that the DSL rate will be considered tariffed and therefore must be assessed the FUSC, correct? So if a company participates in the NECA DSL pool, that's a DSL transmission rate. My presumption is, and this is just a presumption, is that a company could stay in the DSL tariff, even though the question says pool, you could stay in the DSL tariff, but could exit the tariff or de-tariff your consumer broadband only benchmark rate of $42. Not sure about that, but that's my presumption. I don't see anything in the order that would say that the two are specifically tied together. If one's de-tariffed, the other has to be as well. So a comment here, and it says many companies face broadband competition. Absolutely true, and we should not assume that all companies have headroom to increase retail rates. Completely true. I think Stuart's comment was really related to the fact that if the FCC does not allow you to increase your benchmark rate for that ARC, that one option would be to flow that through in your retail rates. Whether competition will allow that or not is difficult to say. The next question is sort of a statement that the $42 benchmark is a tariff charge, and we charge that to the ISP, and I agree that it's likely going to be charged to the ISP. Then the question is, at what speed for the broadband-only line? I don't think that there's any specific speed that's tied to the $42 benchmark rate. It's for that broadband service, that consumer broadband-only loop cost or loop rate is for any speed that the customer would elect for DSL service. All right, several questions still coming in. So with regard to double recovery, would there be consideration of new facilities and new costs for Ethernet internet backhaul circuits versus standard investment in TDM inter-office facilities? So it's a really good question as to when we talk about that double recovery for new special access revenues, how is that really calculated? Is it on existing costs versus new costs? When we look at double recovery for voice services, we know that it has to do with a frozen revenue baseline that is based on costs that have already been incurred. So when we make new investments, those new investments don't really impact the double recovery. So the question really here getting to when we make those new investments or deploy new technologies, would that still be considered a double recovery in that shift from voice services to broadband? It's a really good question. I don't know the answer for sure. My presumption is that it would not, that new investment is not part of that frozen CAF ICC revenue baseline that we're recovering through switched access revenues today, that when those switched access revenues go away should be recovered through this double recovery mechanism. So long story short, I don't think it's going to be, but I don't know. We'll have to wait and see some of the details behind that. When we look back at the 2011 transformation order, the double recovery implications in there were sort of an afterthought for everyone. There were no specific calculations. It really wasn't until we had submitted the 2012 cost study that folks had started thinking about that, the implications of that double recovery. So the next question is, if loop cost is below $42 but above $26, could existing ICLS be eliminated because of negative broadband-only support? It's a good question, and I'm not sure if that is the case or not. I'm trying to think through the $26 is really a $6.50 slick times 4 because ICLS is designed to recover 25% of the loop cost. So could the existing ICLS be eliminated because of a negative broadband-only support? I think it's certainly possible because the two components are now rolled together into one cost recovery mechanism. And so to the extent that a company found themselves in that situation, I think that the ICLS that they currently receive could go away. But need to think about that a little bit more and maybe dig into it more. Next question, when will we know if all the money is gone? Will we be able to accurately forecast budget and plan for continued investment? So I think the all the money is gone comment relates to this attribution of CAF broadband loop support. For the most part, we're going to be able to project what our future revenue requirements are going to be, just like we do today. So we'll know sort of steps 3 and 4 in the process. We know what our common line revenue requirement is going to be. We know what our consumer broadband-only revenue requirement is going to be. As it relates to items 1 and 2, the true-ups for prior year, sometimes those are positive, sometimes those are negative. Sometimes they're insignificant, sometimes they're very significant. And so I think it's going to be difficult to tell. Now, important to understand that this capping of this broadband loop support is on a total basis, so across all rate of return study areas that don't opt into the ACAM. And so support won't be tied to, or that cap won't be tied to an individual company. So my presumption is that we're always going to be able to get through steps 1, 2, and most likely step 3. It's really that step 4 that we don't know how much support there's going to be at the end of the day for consumer broadband-only revenue requirement cost recovery. The next question is, does the DSL revenue requirement go away? And the answer to that is no. We still have a DSL revenue requirement and DSL transmission rates that will be added to the $42 benchmark rate, which really is only designed to recover the cost of the local loop that's currently not recovered in voice and data rates, but is recovered in the wholesale rate for data-only broadband. So we're shifting that cost recovery from data-only broadband DSL transmission rate over to the benchmark end-user rate of $42, and then anything above that $42 is going to be recovered through the broadband loop support. The next question is, will there be a rate floor with broadband only as there is with voice? It's a good question, and I guess the way I would look at it is that the rate floor is the $42. The benchmark becomes the rate floor, but a company can choose to charge that $42 or potentially could just impute it, but you're still going to have to report it. You will not get broadband loop support for any amount below that $42. The next question, since the ISP is typically your affiliate, if you raise the $42 charge, aren't you just charging yourself more money so that you're on a consolidated basis, you're not really gaining any revenue? It's a good point that, you know, these benchmark rates are going to be assessed to your ISP, just like your DSL transmission rates are assessed to your ISP. So certainly the case that your right hand is charging your left hand more. The assumption being, and it's not always going to be right from a competitive environment, but the assumption being that you would flow those costs through to the end user customer. Whether the company can actually do that or not, I don't know for sure, but I think that that's the FCC's presumption that those costs would flow through to the end user. There's a question here that says, can you clarify the ARC changes over time? I'm not sure I'm following the question, but maybe we can follow up on that one after we've sort of wrapped things up. We can circle back on that and maybe ask a bit more detailed question to make sure we get the right answer. So the final question I've got right now, we'll move on and then circle back to questions later, is if we currently charge tariffed rates to our ISP, would the ISP pay the Federal Universal Service Charge, or would Federal Universal Service Charge not be assessed at all? Here's what I'll say is that as it relates to DSL transmission service, I don't see anything in this order that would allow us to stop assessing the Federal Universal Service Charge on the DSL transmission rate. The only thing that I see in this order is that it says that if we detariff our benchmark rate for consumer broadband-only loop service, if that service is detariffed, then we're not required to assess the Federal Universal Service Charge. But if it is tariffed, then we're required to assess that charge. So I hope that clarifies things. All right. Well, a lot of good questions there, and please keep them coming in, but we'll keep moving here. So I've talked a little bit about a cap on the CAF broadband loop support that will be provided. So here's how it's going to work, is that each year USAC is going to publish a target for total support. So that's all study areas combined, all rate of return study areas that don't elect the ACAM. The FCC is going to publish a target amount of support for all of those study areas and a target amount of support for each individual study area. That will be published on May 1st of each year. So that target is subject to any operating expense limitations, capital expenditure limitations, and corporate operations expense limitations that are going to apply to individual companies. The support, that target support amount, is for the tariff year, which spans from July 1st to June 30th of each year. And so now I want to define that target support a little bit better here. So it's going to equal the forecasted support for individual companies times a reduction factor, if there's going to be a reduction factor. But we already have a reduction factor for high-cost loop support. I would envision going forward that we're going to have a reduction factor of some kind for broadband loop support. If you've looked at any of NECA's projections of what broadband loop support may look like going forward, you'll see that there are some small reduction factors applied in those calculations. I would say somewhere in the range of 2 to 5%. So certainly not insignificant, but not huge percentages either. So our targeted support equals our forecasted support times the reduction factor. So let's keep stepping and define what forecasted support and reduction factors are. So the forecasted support is the projection and true-up of support in a particular tariff year by company. So we already talked about how we're going to project how much broadband loop support that a company is going to receive. Remember, it's that ICLS calculation plus broadband loop support costs less broadband loop revenues. So it's the money that's being paid in the current year because it includes true-ups. The reduction factor is going to equal the FCC's budget. So how much money do they have to assign to this CAF broadband loop support, divided by the forecasted support for all study areas for, get this, both high-cost loop support and CAF broadband loop support. So not a big gotcha there. It's just the fact that that same reduction factor is going to apply to both mechanisms. So essentially they're saying we have one set budget here for rate of return, high-cost support, and we're going to hit them equally. If we're 5% over the total cap, each one has to be reduced by 5%. And then any support reductions that a company is going to receive are split between a per-line reduction and a pro-rata reduction. So that per-line reduction is sort of equal treatment for all. However many lines you have, it's the same amount on a per-line basis. So the way they're going to calculate that is they'll take the target support amount times the reduction factor times 50% to split it in half, and then divide it by the total loops that are eligible for support. So that'll be the per-line reduction number that each company will see for each individual line they serve. And then there will also be a pro-rata reduction for the other half, and that is equal to the amount of target support that a company will receive times the reduction factor times 50%. What this is going to do is it's going to hit higher cost companies a little bit harder. The higher the costs are, the more support I receive on a per line basis. It's going to hit me more than an equal support amount on a per line basis. All right, so I want to talk now a little bit about the high cost loop support cap. That cap is currently in the ballpark of about $710 million. I looked up real quick using USAC's second quarter fund projections, and on an annualized basis using those second quarter fund projections, USAC is estimating that there will be about $710 million of support in 2016. So that cap has to be rebased because there are going to be at least some companies that opt into the ACAM. As we talked about yesterday, companies that opt into the ACAM are going to take their legacy support with them. So they're going to take that high-cost loop support with them. So the FCC has to reduce that high-cost loop support cap in order to reflect that. So the way it's going to work is that it will be based on the first annual filing of high-cost loop support following the ACAM election. So we'll start with the high-cost loop support cap coming into that first annual filing following the ACAM election. So that's likely to be next July 1st is when we submit the data for the next annual filing following the ACAM election, which will come, like we talked yesterday, some point later this year. So we take that high-cost loop support cap going into that filing and remove from it the high-cost loop support that carriers would have received absent their ACAM election. And that amount is equal to the rebased high-cost loop support. So that's how much high-cost loop support will go into this budget. And that's the amount that will be used to recalculate the amount of high-cost loop support that carriers that don't opt into the ACAM will receive. So essentially they're going to bake a smaller pie here at that rebased cap. It's a smaller pie than it's been in the past, and they're going to slice it up and distribute it among the remaining rate of return carriers based on each company's actual costs compared to the frozen national average cost per loop, just as we do today. All right, so we need to talk now a little bit about broadband loop support for transferred exchanges. When we buy and sell, what happens to that support amount? Pretty straightforward process, pretty similar to what we'd see today when assets are bought or sold, transition of support. So if a rate of return carrier is acquiring exchanges from another rate of return carrier, we essentially calculate the average broadband loop support per line that the selling carrier receives at the time of the transition. So what we're going to do is we're going to report the updated line counts as of the next quarterly line count filing. So the acquiring company now in the next quarter reports that they have more lines than they did previously, and the selling company reports fewer lines than they had in the prior period. So then from the date of the updated line counts until the end of the year, the amount of support for the acquiring carrier is and for the selling carrier as well is calculated based on the projected average support per line for the selling carrier. So at the point in time of that quarterly filing, calculate the amount of support per line that the selling carrier received. Let's say it's $100 per line and they sold 10 lines. The acquiring company gets $100 more support per line for those 10 lines, so $1,000 more in support, and the selling company receives $1,000 less. Pretty simple process. Then, in the following year, the actual data is filed for true-up purposes, and that reflects the transfer of exchanges, and it's all trued up at that point. And then going forward, the support is based on each carrier's projected cost and line data for future years. Just like we do today in projecting what ICLS would look like, we'll do the same type of projection for broadband loop support, and then we don't have to worry about this adjustment and true-up process. In a situation where a rate of return carrier is acquiring an exchange or exchanges from price cap carriers, the price cap carrier basically transitions to the rate of return carrier the same support and public interest obligations as the price cap carrier has. So same amount on a per line basis and whatever obligation they're subject to in terms of broadband deployment speeds and broadband deployment obligations transfer over with it. Essentially, this is like the parent trap rule as we know it today. When a rate of return carrier acquires price cap assets, they're trapped by what that parent or selling company was obligated to provide and the support that they received. You can't get more support and you can't provide lesser service or have lesser obligations than the selling company had. And then finally, in situations where price cap carriers are acquiring rate of return exchanges, those rate of return exchanges will transition or shift to model-based support, and so it gets pulled out of the rate of return mechanism and shifted over into the Connect America model. All right. So now getting to some deployment obligations. Yesterday we talked in a fair amount of detail about deployment obligations associated with the ACAM election. Well, for any company that sticks on rate of return and receives broadband loop support, there are obligations that come along with it. So we're going to start with a 5-year projection of the amount of broadband loop support that a company will receive. So in the order, the NECA is required to provide a projection of how much broadband loop support that a company will receive over the next 5 years. Obviously, it's just a projection. We don't know if those things will actually come true or not, but we start with that 5-year projection. And I think we talked yesterday that projection is due within 60 days of the order being adopted, and hopefully you'll remember that the order is adopted or effective 30 days after it's published in the Federal Register. So this is going to be 90 days after publication in the Federal Register. We projected that publication in the Federal Register will likely happen sometime in the next 30 days. Long story short, NECA's got about 120 days to provide this forecast of how much broadband loop support each individual study area will receive over the next 5 years. Okay, so we start with that 5-year projection of broadband loop support. We're going to set that aside for a minute. Our commitment of how many new locations we have to deploy broadband to is then based on the current deployment that I have of 10x1 or greater broadband. So if my current deployment, based on that June 2015 FCC Form 477 data, my current deployment is less than 20% 10x1, then I take 35% of that 5-year projection of broadband loop support, and that's how many dollars I have to commit to the deployment of new locations that I have to get to 10x1. The way I'm going to determine the number of locations that I actually have to serve or additional locations I have to deploy to over the next 5 years is I'm going to take that dollar commitment and I'm going to divide it by a cost per location. I'll get to that in a few minutes as to how we calculate that cost per location. I want to continue stepping through the different obligations that are associated with varying levels of existing deployment. So if a company has greater than 20% but less than 40% 10x1 deployment today, then they take 25% of that 5-year CAF broadband loop support projection. If a company has greater than 40% but less than 80% 10x1 deployment today, then it's 20% of that 5-year broadband loop support projection. And again, you're going to take that dollar amount and divide it by a cost per location to determine how many new locations the company has to deploy to. And then any company that currently has greater than 80% broadband deployment at 10 by 1 or greater has no further deployment obligations. They don't have to commit to a certain number of locations. However, they do have to report newly served locations going forward. So again, we take that 5-year CAF broadband loop support commitment that we just calculated. We're going to divide it by a cost per location to come up with a 5-year commitment of new locations that have to be served with 10 by 1 or greater broadband. So we then have two options that we can utilize to calculate the amount of support per location we have. But before we get to that, we're going to jump into our fifth polling question, get that out of the way, and then we'll talk about those two different options to calculate the cost per location. So let's go with the polling question. So the question is, my company's current broadband deployment is less than 20%, between 20 and 40%, from 40% to 80%, or greater than 80%. And of course, that's important in determining how much of that broadband loop support we're going to have to assign to the deployment of new locations. So important to understand what that number is. If you don't know what it is, you can go to your FCC Form 477 data. There's information in the results of the ACAM model that'll tell you really what those answers are. So that information is out there if you're not aware of what the answer is today. Okay, so now let's talk more about the two different options for calculating the cost per location. So the first option has sort of two different approaches. It's the higher of the following two calculations. First, we'd look at the weighted average cost per loop for carriers with similar density, so carriers that are similar to your company, and have broadband deployment to 95% or more of the locations. So density is the same or similar, but broadband deployment is different. Because if we're doing this calculation, it means that your broadband deployment is less than 80%. So essentially, they're looking at companies that have similar density to you, but have already deployed broadband across the board. And that'll be based on data from the most current FCC Form 477. Again, we're thinking that that ties back to that June 2015 data that's already been reported. And it excludes any carriers that are currently subject to the $250 per month per location support and or any expense limitations. So essentially what they're saying is that, hey, when we do this calculation, we're going to remove the highest cost carriers out there. Okay, so now the second portion of that first option. Remember, it's the higher of these two. Second option is 150% of the weighted average cost per loop for carriers of a similar density to your company and with similar broadband deployment to your company. So essentially, it's looking at your peer group and saying, hey, these companies are just like you, but we're going to look at their average cost to deploy, so a wider group than just your individual company's average cost to deploy. So a wide group's average cost to deploy. Then they multiply it by 150% to reflect the fact that locations that haven't been deployed are likely the higher cost locations, so they can't just use a simple average cost. So that's option number one. Option number two is to take the average cost per location from the ACAM for census blocks that are unserved, which means that they're lacking 10 by 1 broadband throughout your entire study area. So they look at the ACAM, take all of the census blocks that are listed as unserved or lacking 10 by 1, and come up with an average cost for your study area. So you would use whichever of those two options you prefer. Obviously, we would want a higher cost per location if possible, because when you take your 5-year commitment of broadband loop support dollars and divide it by a higher loop cost, that's going to produce a lower number of locations that you have to deploy to over the next 5 years. And obviously, we want those obligations to be as low as possible, understanding that you want to deploy broadband wherever you can, but as costs get higher and higher, you want the obligations that you're going to be held accountable to be a bit lower. All right. So I want to keep talking about some deployment obligations and some restrictions that you would have. So we've just gone through and calculated the number of new locations that a company would be obligated to provide service to. And the FCC has said, well, there are some situations where we don't want you to actually do that. So here are those restrictions. First is if the deployment of wireline technology to reach those new locations would cause your total support to exceed the $250 per line per month cap that was established in the 2011 transformation order, well then, hey, wait a second, we're not going to have you deployed to those locations. The second restriction is that companies are not required or not allowed to deploy wireline technologies to locations that would exceed $10,000 per location per project in capital investment. We'll talk in a little bit about, or actually we'll talk tomorrow about the capital budget mechanism as we've always known it. The FCC has given it a different name now, but we've always talked about the capital budget mechanism. It includes a calculation that would limit the amount of investment that a company would have on a per location basis. So those are really the two restrictions that come into that. They're going to calculate the number of locations you have an obligation to serve, but you don't have to serve them in these situations. And then a future deployment obligation consideration is really this isn't a one-time deal. It's going to be recalculated each 5 years. So we'll look at broadband deployment data in 5 years, cost data in 5 years, and then these density groupings will be updated, and they'll recalculate the number of locations that you have to deploy, let's say in years 6 through 10. And so presumably if a company in years 1 through 5 reaches that 80% threshold above which there are no fixed obligations, there wouldn't be any additional obligation going forward in years 6 through 10. But for companies that have not yet reached that 80% goal, presumably there would be similar type of obligations going forward. All right.
Could I just make one quick comment on that? Yeah, so I just wanted to point out that, one difference there in terms of the broadband obligations with ACAM, with ACAM carriers have interim milestones, that they have to hit while they're, while they're, getting to 100% or 95% by year 10. On the rate of return side, there's no interim milestones. You just have to hit your target by the end of year 5.
Okay, great. Thanks, Stuart. All right, so want to talk a little bit again about the reasonable request standard. We touched on it a fair amount yesterday, but it still applies to rate of return support as well as ACAM support. So these companies that opt into rate of return as opposed to the ACAM will remain subject to that reasonable request standard for all locations that are not included in the deployment obligations. So we talked about deployment obligations here just a couple minutes ago, and so anything that doesn't fit into that, so we calculate that we have to get to 100 new locations over the next 5 years, and we do that in year 3. That doesn't mean that we're done, we never have to do anything again. Additional customers come and say, hey, I'd like broadband deployed to my location. We're going to have to look at that reasonable request calculation and make sure that we should or shouldn't deploy to those customers. And this is, I can't emphasize this enough. I know I said it probably 2 or 3 times yesterday, but there's just this note that flows throughout this entire USF reform order that really talks about, accountability to this process. So carriers have to be able to demonstrate a documented process for evaluating the requests for service under the reasonable request standard. If you remember, that calculation is generally, do my costs exceed the revenues that I'm going to receive from those customers? However, the FCC has not yet defined, and I don't think they're going to define, a specific calculation that's to be utilized there. But they've indicated that under review or audit, you'll be held accountable to being able to show that you performed a proper calculation and deployed where the request was reasonable, and presumably did not deploy where the request was not reasonable. Okay, And then again, this is consistent with what we discussed yesterday related to election in the ACAM, that companies are encouraged to identify any census blocks that they don't expect to serve over this funding time frame. So in this case, really, we're looking at a 5-year horizon. And so what's going to happen there is the Wireline Competition Bureau is going to identify a date of notification, presumably about 60 days from the final election of ACAM support. At that time, both ACAM recipients as well as companies that stay on rate of return can go to the FCC and say, here are some census blocks that I don't intend to serve. I just don't think I can get there, even under a reasonable request. So those census blocks would be included in what we're calling a Remote Areas Fund auction. Remote Areas Fund is a concept that the FCC has sort of held out there since the transformation order was issued. And so they keep talking about having this Remote Areas Fund to provide funding in areas where no one else will serve. So those blocks that are sort of turned back in would be included in that Remote Areas Fund auction. The incumbent would be allowed to bid for support in that auction. And if they win it, then they have obligations associated with those census blocks again. However, if the incumbent does not win the auction and someone else does, then the incumbent's not required to serve upon reasonable request. But presumably, if no one bids on that census block in the auction, so there is no winner, presumably the reasonable request standard falls back to the ILEC that turned the census block back in for auction. Again, if it's truly a high-cost census block, the likely answer is that you wouldn't be able to provide service there, even under a reasonable request. And then in any situations where the incumbent turns those census blocks back in and the auction is won by a competitor, then the amount of support that the company receives would be reduced to reflect those fewer number of locations. All right, well, we're going to go ahead and jump to our 6th polling question, and then we'll try to answer some questions that have come in via Q&A, and then we'll move on from there. Okay, so the question is, my company has census blocks that we are not likely to serve, even under the reasonable request standard. True or false? So are there some areas that you think that your company just will not serve, even under the reasonable request standard? No right answer here. All right, so we'll go ahead and close that out and try to answer a few questions that have come in via Q&A and go from there. So first question is, how do average schedule companies factor into all of this? Average schedule companies will be eligible for broadband loop support, just like they're eligible for ICLS and HCLS today. Those calculations will be performed consistent as they are today using an average of a large number of companies. They look at about 100 steady areas, come up with average costs, determine the average schedule settlements, and in that process, it determines how much high-cost loop support and ICLS that a company is going to receive. Essentially, it establishes a revenue requirement that then is reduced by benchmark revenues, SLIC, the benchmark rate, so on, and the remainder would be eligible for support. Typically, average schedule companies don't receive a lot of universal service funding, but there are situations where they do. So, okay, the next question is, the FCC always shows almost double the amount of customer locations via their census numbers compared to how many customers we have. They say we need to provide service to new locations greater than our customer base. How is that reconciled? And again, just a reminder that, locations are houses, buildings, things along those lines. Physical locations, not people, not subscribers. And so what you're going to be reporting is the availability of service to a house or to a building, and not how many customers are actually subscribing to that particular service. So essentially you're saying, I'm making the service available to these customers if they choose to take it, and then those costs are recoverable. The next question is, Do we have to offer data-only broadband at the $42 benchmark, or could we continue on as we are today with only offering voice and data DSL? It's a good question. I'm not sure that there's anything that requires a company to offer broadband only or consumer broadband only service, but I'm not 100% sure. I didn't see anything specific in the order that would require a company to offer the service. However, since it is supported, I think there would probably be some incentives to do that. I'm going to check and see if Stuart has any additional thoughts or comments on whether he feels that the consumer broadband only service would be required, or if a company could continue, as many do today, and say you have to order a voice line in order to get broadband.
Yeah, I agree with you. I didn't see anything that would require an offering. I think they did that because there are many rural ILECs that felt like they would be, competitively in their best interest to be able to offer a broadband-only service because customers are, dropping voice lines, and at least they'd be able to hold on to the customer for one service. But, if a company doesn't feel like they want to, I don't see why they would be required to.
Sure. Okay, great. All right. So the next question is, if a company stays under rate of return, so they don't elect the ACAM, are they required to deploy to 95% by year 10? And the answer there is no. The deployment obligations are tied into that calculation of how much broadband loop support do you receive, what level of deployment do you have today, divide that broadband loop support commitment by an average cost per location, and that's your commitment over 5 years. And so, no, it doesn't hit that 95% threshold. Actually, it really appears that it's an 80% threshold, because any company on rate of return that's above that 80% deployment does not have any additional deployment obligations besides reporting any new locations that they do happen to get to. So then the last two questions that I've got here, and actually I see a few others coming in directly to me, but these last two questions I'm seeing right now are basically the same. So I'm going to just ask one of them and answer, and hopefully it covers both. So if we were to turn in census blocks, so census blocks that we don't plan to serve even under the reasonable request standard, how does that impact our state carrier of last resort or provider of last resort requirements? And I think this is just like with the ACAM that we talked about yesterday, that there is no impact on your carrier of last resort or provider of last resort obligations from the state commission. This certainly does not circumvent the state from regulating the voice services you provide, just as they do today. And so I don't see any change in that regulation. So a little bit unfortunate that there could be a bit of discrepancy between regulation on the interstate side as well as regulation on the intrastate side. But I don't think that they're going to tie those two together. Okay. We'll go ahead and keep moving here. I think we've got all the questions covered. So I want to talk now about some reporting obligations, and you're really going to see some very consistent obligations to what we see today from an ICLS perspective. So we look at an annual line count data submission. We've got to report residential and single line business lines. Got to report multi-line business lines. I think this gets to Tim's question earlier, so hopefully this answers it, Tim, but please clarify as needed. We report consumer broadband only lines. And I don't recall the exact section of the order, but pretty sure I pulled this directly out of the rules, and I don't think that there was a differentiation on the consumer broadband only service between residential and single line businesses. And then finally, we do have to include any lines that are provided via resale. All right, and then there's a voluntary quarterly line count data submission. Typically, we don't see that used outside of acquisitions. We had historically had quarterly line count reporting for competitive purposes when a study area support was disaggregated, but we don't see that regularly used. Certainly a company that did an acquisition or a sale would want to do the quarterly line count data submission in order to properly increase or decrease the amount of support they received. There is an annual broadband loop support projection, just like the ICLS projection that we do today. We submit our forecast of cost to NECA in February. NECA massages, reviews the data, and so on, and sends it back to us for certification, and then submits that to the FCC by March 31st. So that submission will include common line costs, just as it does today, and going forward will include the consumer broadband-only loop costs that we discussed earlier. It also includes the common line and consumer broadband-only revenue projections. So again, we provide forecasts of costs to NECA in February. NECA massages the data, sends it back. We have to certify it, and then once it's certified, NECA submits to the FCC prior to March 31st of each year. All right, so now we get to the bad stuff. We have to start talking about the elimination of support in areas where there's a qualifying competitor. We talked about this pretty extensively yesterday related to the ACAM, and so we've got a similar approach here from a rate of return perspective. But I'm going to start with a caveat that there's a little bit of good news here in that, again, don't want to paint with a broad brush. There's certainly going to be some companies that will be hit hard by this qualifying competition, with support being eliminated. But in most cases, we think that there are going to be ways to significantly mitigate the impacts of it. So start with the fact that it applies only to CAF broadband loop support and not high-cost loop support. So that's good news there, that our high-cost loop support will not be impacted. Definition of a qualifying competitor, not much has changed here, but there's a couple of new wrinkles. Still have to offer voice service that essentially meets the ETC designation standards, 10x1 broadband or greater, with latency suitable for real-time applications. So essentially we've got to have voice over IP, that 100 millisecond or less latency from end to end of the network. Usage capacity limitations that are reasonably comparable to urban areas. So we talked yesterday about that being the greater of 150 gigabytes per month, or the nationwide average that's being offered to customers. Now here's the new wrinkle, is that competitors have to have the ability to port numbers from customers. So if a customer decides to leave your network or come back to your network, I guess, from a competitor, that competitor has to be able to port numbers to and from. So that's a bit different than we've seen before, and I think adds a little bit of meat to the process that some competitors won't be interested in. Having said that, the ability to get numbering resources and to port numbers back and forth is probably easier than it's ever been before, so this might not be a hugely limiting factor. The qualifying competitor also has to have service available to 85% or more of the locations in a census block, so not the 100% standard that's used in the ACAM, an 85% overlap standard. And then finally, they have to be willing and able to extend service within 10 business days. So this means that they don't have to have service right to the customer today. If the customer requests service, so long as they can meet that request within 10 business days, they'll have been deemed compliant. All right, so interestingly and nicely, there will be a challenge process, one that's more thorough and with more teeth to it than the challenge process associated with the ACAM. So here's how that process is going to work. The Wireline Competition Bureau is going to publish a preliminary list of competitors by census block. And I say it's preliminary because, we'll go through this challenge process and some of those will be eliminated. Hopefully a lot of them will be eliminated. So the Wireline Competition Bureau is going to publish a preliminary list of competitors in each census block, and believe that that'll be based on the June 2015 FCC Form 477 data that's already been submitted. So then there will be a comment period for competitors that are required to certify that the requirements that we just discussed are met for 85% of the locations. And they don't just send in a letter saying, I certify that I can do all of these things. They actually have to include some evidence that establishes the availability of service to those locations. So there are no specific requirements. The FCC in the order doesn't say you have to do A, B, and C. They say here are some ideas as to how you can prove that you have service available to those locations. They can show for a cable provider the franchise territory boundaries. They can provide a list of neighborhoods that they serve. If they want to, but they don't have to, I think it would obviously help their cause, they can provide a list of geocoded locations where service is currently available. So those are some options. There are certainly other approaches that competitors could use in order to sort of certify and show that they have service available. There was no discussion of the time frame in the order as to how long this comment period will last. But this process is very similar to what was utilized in the 100% competitive overlap proceeding. So I'm going to draw some parallels there. In that proceeding, the FCC allowed a 60-day comment cycle for competitors to come in and make their showing of competition. Following that 60 days, then there's a reply comment period that will allow incumbents or other interested parties, associations, or whomever wants to weigh in to respond. Again, it's not just a letter saying, hey, they're completely wrong. It's a requirement to provide some supporting documentation as to why they're wrong. So some examples of things that companies can utilize to show that the competitor is not truly providing service are items such as the competitor's online service availability tool. So, hey, we're checking into this tool and we documented that we entered these addresses and service is not available there according to their own online tool. We can also go to customers to get certifications that service is not available or the requirements, those obligations we defined previously, have gone unmet. So basically customer testimonials saying, yeah, they said they were going to do all of these things, but they haven't actually done them.
And Chad, I just wanted to kind of comment that this process certainly has improved from the 100% competitive overlap process, where really a lot of the onus is on the competitor now to prove that they are in this area by not just simply providing a certification or, the certification that is provided with the 477. They have to actually provide some meat to that they are able to provide this service, and then we have the ability to dispute that in what seems like they've learned their lesson from the prior process.
Yeah, I completely agree, and great point, Tim, in that, even though the sort of burden was on the incumbent in that 100% competitive overlap process, and like you said, hey, this is a much improved process. In that 100% competitive overlap process, we had 15 companies go in as being preliminarily 100% overlap. Only one of them came out as truly being 100% competitive overlap. So either the competitor just didn't come to the table, or the incumbent was able to prove that there wasn't truly 100% availability. So it's good to know that 14 out of 15 did not have competitive overlap in that situation, and that they've tightened the reins a little bit here on the competitors. So hopefully that will, prove to be a strong indicator that there won't be a whole lot of competitive overlap as a result of this process. Yeah, go ahead.
Oh, and I was going to say, and as we didn't really touch on it in the obligation build-out portion, but when we are determining the number of locations that we'll need to build out depending on the amount of BLS that we will receive, locations that are deemed competitive are not eligible to be to fulfill that requirement. So only non-competitive census block locations would be able to get you to your 5-year end mark of deployment.
Right. Yeah. Okay. Great. So in terms of walking through this challenge process, Again, this is going to vary based on individual study areas, so some situations could be different, but it's really going to hinge on the competitor and will they or won't they go through the trouble of this process, because their only benefit is not, they don't get the benefit of support for themselves, their only benefit is to reduce support that you receive. So they're going to have to incur additional cost and go through the process in order to do that. So there's some question as to whether competitive providers will go through that hassle or not. But if the competitor goes to the trouble, that means that you will have to do the same as well. And then just, this isn't a one-time challenge process, but they're not going to do it each and every year. They've established a 7-year cycle for it. So every 7 years, that competitive challenge process will be updated, so competitors could come or competitors could go. Revised and updated data will be used at that point in time. So we're going to go ahead and do polling question number 7, and then we'll answer some additional questions that have come in via the Q&A function. So polling question number 7 is, I believe that the FCC's proposed challenge process will prove effective in showing the true level of competition in my company's study area. True or false? So do you think that the FCC's got it right or close enough to right that it's going to be an effective process here? And I don't know for sure, but I certainly think it's a much better process than we've seen before, and certainly is better than the initial assumption that came out with the ACAM. That was whatever the FCC Form 477 says is 100% true, and we're just going to take it for its worth because that's certified data. All right, so why don't we go ahead and answer a few questions that have come in here via the Q&A function, and then we'll move on from there. Okay, so the first question here is, if the incumbent doesn't win the auction, oh wait, we already talked about that. I apologize. I'm going to shift to the next question. Is there a chance that the FCC will adjust the 10:1 speed after year 5 to something higher like 25:3? So good question. I believe, just like we talked about yesterday related to the ACAM, that 10:1 obligation will remain for the funding period. In this case, they've forecasted that funding period to be 5 years, and I certainly think that it's possible that at the end of that 5 years, they say, if you're going to stay on rate of return, well, because you've stayed on rate of return and you get recovery for your actual costs, we're going to up the standard here to 25:3, and costs that you incur in doing so will be included in the calculation of support you receive. So I think it's highly likely that that could happen. The next question is, since as a national average, most wireline ISPs aren't enforcing any kind of data caps, does that mean the national average is unlimited, eliminating some fixed wireless competitors? I don't think that's the case. I think what they'll look at is situations where companies do apply a data cap and develop that national average based on situations where a monthly limitation is applied. So the next question is, the total locations in ACAM is based on the 2010 census locations and not existing or current plant locations. And that is correct. It's based on census data of, I'll say households, but physical locations that are measured during the last census. The next question refers us back to slide 18 and asks, does the competitor also have to meet the minimum usage and for all plans? So the competitor does have to meet the minimum usage requirement, but I don't believe it's for all plans. When the FCC has established these requirements, even of the incumbent, it's that they offer a plan, at least one plan, that meets all of those obligations. So the 10:1 standard, the latency standards, the usage limitations, and so on. And so I believe that for the competitor, they'll have to have one offering that meets those particular obligations. The next question is a qualifying competitor required to offer standalone voice service? It's a really good question. I'm not 100% sure, but I'm going to say that I think they would have to because a qualifying competitor under the voice service requirements is essentially held to the same standards as an eligible telecommunications carrier is. And in order to be an eligible telecommunications carrier, you do have to offer standalone voice services. So, Stuart, I don't know if you have any other perspective on that, but that's my initial view of it.
I agree.
Okay, great. The next question, does the competitor's pricing have any relevance to the determination of whether it is a qualifying competitor? I can't say that for sure, but again, I'm going to sort of pull back to that slide 18 where we talked about a qualifying competitor and them essentially meeting the same requirements as an eligible telecommunications carrier does and including the broadband requirements. And so the broadband requirements say that you have to offer at 10 by 1, 100 millisecond or less latency, 150 gigabytes per month in capacity, and at or below a reasonable rate, which is measured as 2 standard deviations above the national average, which I believe Stuart defined yesterday as approximately $77 and change. So I think the answer to that is yes, that in order to be qualified or deemed a qualifying competitor, they'd have to certify that their rates are reasonably comparable. So the next question is, what penalties, if any, will competitors have for certifying coverage that is overstated? I'm not sure what penalties can be applied. These are not companies that receive support, so I'm not sure what the FCC can take away from them. But again, remember that the certification is not just a letter that says, I certify I do this. They have to provide supporting documentation. So presumably that supporting documentation would either prove that they can do it, or if it's not accurate, then the incumbent could rebut that and show that they can't actually do it. The FCC then bears the burden of determining who's right, the competitor or the incumbent, and making a final decision on that. I think if we look back to the 100% competitive overlap process, we'll see that in most cases they sort of deferred to the incumbent as opposed to the competitor. But, you know, it will be an interesting process. And just a comment here from a very knowledgeable source out there, so I always appreciate it. This is based on what happened in the 100% overlap filing. Companies like specifically mentioning Comcast and other cable providers will take the time to make the filing. Some fixed wireless providers will not. So I think a really good point. The big guys, the cable providers that have a lot of resources, will take the time to do that filing because they know the value of USF support to you in competing with them. The small wireless carriers and maybe small cable providers may not have the resources to go through that process and to sort of fight the battle, if you will. Another question just came in, so we'll try to answer that before we move on. It says, will you clarify? An affiliate could be a qualifying competitor, but it wouldn't matter because the affiliate wouldn't file to certify, correct? Absolutely good point, that there could be an affiliate that qualifies as a competitor, but it's sort of eliminated from the process because hopefully your affiliate wouldn't go in to certify and to show that your support should be reduced. All right, so we're going to keep moving now, and we'll get back to additional questions as they come in. But here's sort of a, I won't say the saving grace, but a potential saving grace is that in areas where the FCC deems that there truly is qualifying competition, so we go through this challenge process and the competitor is proven to be a qualifying competitor in certain census blocks, the FCC has recognized that, hey, not all census blocks are created the same. The FCC recognizes that costs will vary by location, and the competitors aren't going to come in and serve the really high-cost locations. They're going to focus on sort of cherry picking, if you will, the lower cost locations. That's not always the case, but in general, we see the competition in our most densely populated areas. In the remote, high-cost, very rural areas, we don't tend to see competition. Remembering that this is fixed wireless as well as wireline service, not mobile wireless services. So they've allowed for a disaggregation of support in those competitive areas. And what that does is it adjusts support to reflect the variance in cost in those competitive and non-competitive areas, recognizing that there's more support that is necessary in the non-competitive high-cost areas as opposed to lesser support in the competitive low-cost areas to serve. So in the order, they provide 3 available options for disaggregating support, and those are defined fairly well in the order as well as in the rules. There's a density-based approach, there's a square mileage-based approach, and there's an ACAM support-based approach. And companies can pick any one of those 3 that they like. In addition, in the further notice of proposed rulemaking, and we'll talk more about this on Thursday, is that companies can come in and try to provide documentation around other potential methodologies for disaggregating support. And so regardless of what methodology a company chooses, the FCC has the authority to review that methodology and, basically to audit it. So the calculations aren't specific. There aren't exact, precise rules that say this is exactly how it has to be done. There's some pretty strong guidance there, but there certainly could be some areas for interpretation. So what we encourage folks to do is to calculate, if you have qualifying competition, to calculate your disaggregation using all of the methodologies available and to then select the lowest. However, our belief is that you'll have to select your methodology, report it to NECA or USAC or to some regulatory agency and say, this is the methodology we've selected, and here's the impact, and then you'll have to stay with it. We don't think companies are going to be allowed to bounce back and forth. All right, so let's start talking a little bit about what these disaggregation methodologies are. This first one comes across as a bit complicated just because there are a lot of steps in the process, but it's really not that complicated. I'll try to walk through it as quickly as I can. So this density-based disaggregation. First, we start with a definition of density. It's locations, which in this case is defined as households in the census per square mile. And so we start with a baseline of our total study area density factor is 1. So the average density is our baseline, and this is calculated on a study area basis. We then calculate a competitive density factor. So we take our total density divided by our competitive density. And that's going to, in most cases, so long as the competitive areas are presumably less dense than our competitive, or I'm sorry, than our total study area, that'll produce a competitive density that is lower than our average density. We then calculate a non-competitive density factor, which is our total density divided by our non-competitive density. So again, presumably our non-competitive density is going to be lower than average, so lower than 1, and is going to produce a non-competitive density factor that then is greater than 1. So then once we have our competitive and non-competitive density factors, we need to determine how much competitive and non-competitive cost per loop we have. We're going to do that by taking a study area cost per loop. I want to make sure I'm clear here that this is not the study area cost per loop used in the calculation of high-cost loop support. I just needed a convenient acronym, so I didn't have too many words on this page. It's really the cost per loop that will be associated with our broadband loop support. So we take our study area cost per loop times the competitive density factor to get a competitive cost per loop. We do the same with the non-competitive density factor. So that's going to produce a competitive cost per loop that's lower than the average and a non-competitive cost per loop that's higher than the average. We then take our competitive cost per loop times the number of competitive loops we have. There's a bit of a challenge here because in the information that's produced out of the census data, it doesn't provide us loops in competitive census blocks and non-competitive census blocks. It provides us locations. So presumably we have to do an allocation of loops based on the number of locations in competitive and non-competitive areas. So our competitive cost per loop times the number of competitive loops we have produces a competitive cost. And the same is true on the non-competitive side. So then what we're going to do is we're going to take our competitive cost divided by our total cost. That produces a competitive ratio. We take our competitive ratio times the amount of broadband loop support we receive, and that's going to be the amount of support that is reduced. So that's the amount of support that's associated with those competitive census blocks. That's what's going to be removed. So I know a lot of steps in the process, but when you see the math of it, it's fairly straightforward. So that's option one. The second option is another interesting one that's a bit easier to calculate. It's based on square mileage. And what we're going to do is we're going to calculate the square mileage of competitive and non-competitive census blocks. The FCC is going to identify for us what census blocks are competitive and which ones are non-competitive. We can use mapping software to determine what the square mileage is of each census block, and therefore how many competitive square miles we have, how many non-competitive square miles we have. We're going to then calculate a competitive ratio, that is square miles in our competitive areas divided by our total square miles. We then are going to apply a reduction ratio that's given. So you'll see this table of reduction ratios that are based on how much competition. So that reduction ratio is given. That's a really smart guy that many of us know and may well be on this webcast today, came up with this calculation that really says, hey, the more competitive the study area is, the more cost that's included in those competitive areas. So we start at a competitive ratio of 0 to 20%. We have a very low reduction in our support. So if I have 20% competition, I'm going to reduce my support by 3.3%. So I start at a really low proportion, but then by the time I get up, above 80%, I'm really starting to get almost to a dollar for dollar reduction in my support, which seems to make a lot of sense. The FCC saw all the documentation behind that and said, yeah, we think that this is a reasonable estimate of the costs that would be included in competitive and non-competitive areas. So a fairly simple and straightforward calculation, because all you have to do is calculate your competitive ratio, and then the reduction ratio here is a given factor. All right. So the third methodology that the FCC has defined is based on the ACAM support. So they calculate a competitive ratio based on the support in competitive census blocks from the ACAM divided by support in all census blocks calculated in the ACAM. And one reason why, so this is pretty straightforward, not much that you have to do. The FCC is going to define what census blocks are competitive, which ones are not. You basically just have to take the model calculated support in each and come up with that competitive ratio. The positive here is that there's no support identified in the ACAM with census blocks that are below $52.50, which means, and those are likely the census blocks where there's most competition. If you walk through the ACAM results and look census block by census block, the vast majority of competition is in the lowest cost census blocks where there is no support. There is a question in my mind here, though, with this particular calculation, and that is, how do we calculate support in census blocks where the costs are above $252.50? Do we leave it at the capped $200 per location, which I'm presuming is the answer, or possibly what I would prefer is that in census blocks that are capped, we would recalculate the support absent that $200 per location cap so that these higher cost areas that are likely less competitive would receive more support assigned to them. So at the end of the day, we take that competitive ratio times our broadband loop support to come up with a competitive support reduction. This approach is pretty simple. No company-specific calculations really required. You just pull data out of the ACAM. However, there are concerns that it may lend credence or validity to a model that many rural ILECs don't agree with this ACAM. So 3 different approaches here. Like I said previously, their further notice of proposed rulemaking will sort of open this up for companies to introduce other alternatives that may be viable. So it's possible that we come up with some other approaches that are out there.
And Chad, on that the reduction schedule for the competitive areas and based on square mileage, do you think that that is accurate? The portion where it's 0 to 20 is 3.3%. So feasibly for a company that has 0 competition, I mean, per what that's right out of the order that it would say that you're going to lose 3.33%. Even if
well, I mean, clearly one of the benefits of having at least 3 alternatives here is that a company could say, hey, wait a second, I've got 0% competitive, so I'm going to go to this simple ACAM calculation that would then say, okay, if I've got 0% competitive, it would calculate no support reduction. So I agree with you that there may be, especially at the low end here, there could be some concerns that would say, wait a second, maybe between 0 and 10%, there shouldn't be any reduction at all. But the benefit here is we can go to one of the other alternatives and say, well, that doesn't work for me in this situation, so I'll move elsewhere.
Right. Okay. Thanks.
No problem. All right. So now, just like there was with the ACAM, there is a phase-in for any support reductions that are calculated, but it's a different calculation. In the ACAM, we saw 3 different tiers. Here for rate of return support, we have 2 different tiers. So we're going to start with the first tier with there being less than a 25% reduction in total support. And just to make this simple, I'm going to use a $100 example as we walk through this. So I have $100 of support in competitive areas, or $100 of support that's been identified for reduction in those competitive areas. So I went through all my calculations. I said, okay, as a result of all of this, I'm going to lose $100 of support. So if that $100 is less than 25% of my total support, in year 1 after implementation, I'd receive $66 of that support. So I only lose 34% of it. In year 2, I receive $33 of support. So I've now lost 67% of that calculated reduction. And then finally, in year 3, I've lost all of that $100 of support. The entire impact of competitive overlap is fully implemented as of year 3. So now in situations where I've got greater than a 25% reduction in support, it's a 6-year transition, generally sort of phases down at 15 to 17%. So in year 1, I start with, and I receive 85% of that calculated reduction. So if I'm destined to lose $100 over time, I'm going to lose only $15, receive $85 in year 1. Year 2 is 68%, year 3, 51%, and so on until year 6, where that $100 has been completely phased out, and I'm not receiving that support in those competitive areas. So pretty straightforward process here, but just split into 2 different phases depending on the amount of support that I would lose. Unfortunately, if I'm a company that loses 24% of my support, I'm going to take that hit over 3 years, whereas if I lost 1% more support, I'd get to phase it in over a little bit more time. But there always has to be a cutoff point at some spot. So on that note, we're going to get to our polling question number 8, and then we will circle back to additional questions that have come in over the last several slides. So Jay, if we could bring up number 8. Okay, based on what I know now, my company will elect rate of return support. True or false? So you've heard a lot about the ACAM yesterday. You've heard a lot about rate of return support today. Based on that information, where do you think your company's going to go? Going to opt into the ACAM or stay on rate of return support as modified? Okay, we'll go ahead and close that out. And so that's the end of the prepared materials. But like I said, I want to get back to the question and answers that have come in. Once we get through all of these, and please continue sending them in, Once we get through all the written question and answer, we'll close things out for today, and then we'll open the lines up for any follow-on live Q&A. A comment that came in, sort of related to the discussion we had earlier about carriers, cable providers coming in and participating in the competitive overlap process. A comment here is that I don't believe that large competitors like Comcast offer standalone voice. I'm not sure about that, but certainly a good comment. I know that I live here in a larger city, and I can get standalone voice service here from my cable provider. So I'm not sure how that would work in more rural study areas, but certainly here in this metropolitan study area, I can get standalone voice service. Question here, for the density-based disaggregation, how will density be measured? If housing units are used, won't that understate density where competition is more likely, i.e. commercial business areas? And my understanding is that in these competitive overlap situations that they are using housing units and not total locations from the census. But we can certainly check into that and see if that's the case. But that was my read of it. Stuart or Tim, I'm not sure if you saw it any differently, but that's how I was reading the competitive overlap, is that it would be based on housing units and not necessarily on total locations in the study area.
Yes, that's how I read it as well. I think they make a comment here in the order that there really isn't any good publicly available business and housing locations information. And so I think it was really just the availability of the housing unit information rather than it being 100% accurate and totally reflecting all possible locations.
Right.
To calculate that.
Okay, great. This next question refers directly to slide 20 and asks, will the results of the 3 options for disaggregation be contained in the ACAM model or somehow otherwise provided by the FCC? I think the answer to that is no. I think it's going to fall upon the individual company to do those calculations and to make their selection, document that, and provide it to whoever the reporting agency is going to be, presumably NECA and or USAC. So I don't think that the options will be calculated and provided to the companies. I think those calculations will have to be performed separately. Okay, a follow-up question here related to whether your own company is a qualifying competitor or not. So the question is, wouldn't your own company eliminate the ILEC from receiving CAF broadband loop support because the FCC's list of competitors is based on the FCC Form 477. I think that's a good comment. I know that there have been a lot of discussions with the FCC related to qualifying competition provided by ILEC affiliates. And really where the determination came down is that when the affiliate is providing service in meeting the carrier's obligation or alternative technologies are being used in providing the carrier's obligation to provide voice and broadband services, that would not be deemed as qualifying competition. So what we're ending up seeing is that initially we saw a lot of situations in the ACAM where the company's own affiliate was deemed to be qualifying competition. It appears that the FCC has sort of fixed that issue, and we're really not seeing situations now where the ILEC affiliate is being deemed as a qualifying competitor. Okay. Oh, interesting comment here, and I appreciate this coming in from the wise person who did the calculation themselves. So indicating that there may be a typo here in the square mileage disaggregation indicated that there is a typo in the square miles disaggregation proposal in the FCC's order. So I think we're showing it correctly, but that the FCC's order may have shown it incorrectly. So what my friend here is indicating that the 0 to 20% competitive coverage is 0% reduction ratio. And there is a 20 to 25% threshold that would be at 3.3%. So I think getting to Tim's point, which was an astute one, that, hey, wait a second, if I had 0% 0% competition, why would I lose 3.3%? And the comment here is the intent was for it to be 0 to 20% equals 0% reduction in support, which would be great. And then there is another ratio or threshold here that would be between 20 and 25%. That would be at the 3.3% reduction. And then 25 to 30% would be the 6.7% reduction. So Trey, I appreciate you clarifying that. And like I said, real smart guy that put those calculations together. Okay. Next question is, if there are no competitive census blocks for a study area on the FCC list that will be provided, is the ILEC safe for 7 years from having their CAF broadband loop support reduced due to competitive overlap? And I believe the answer to that is yes. They're going to go through this competitive overlap process every 7 years, and there won't be any interim steps or interim reviews between now and then. Next comment here is about a smart guy that came up with the ACAM support methodology as well. I appreciate that comment. That was one of my few contributions to this order, so I appreciate that. Let's see here. If there are no competitive census blocks listed for an ILEC on the FCC's list, is there any reason for that ILEC to disaggregate support? And the answer for that would be no. If after 7 years there is competitive overlap determined, then the company would have the opportunity to then go through a disaggregation calculation at that point. So next question or comment. I believe that we recalculate support without the $200 cap. Referring to the ACAM-based support calculation. And I agree with this, and I think it's the right approach to take, is that if a company were to elect that ACAM-based disaggregation of support, that the calculation of support would be based on a uncapped amount, so without that $200 limitation, because then you really determine the amount of support necessary to fund those locations. All right, next question, and we've got a few more coming in here. Has the FCC estimated the reduction in total to the high-cost fund due to competitive overlap? Will this reduction help the USF overall budget or be diverted elsewhere? I don't think that the FCC has really got a good handle on how much this competitive overlap will impact companies. I know Stuart and I talked about it the other day, and he had an interesting calculation. I'm not sure if he's willing now to sort of weigh in with a just sort of ballpark, back-of-the-napkin estimate of what those calculations could look like. But Stuart, if you recall that discussion, do you mind sort of weighing in on your thoughts there?
Yeah, well, first of all, I'm happy to, but, you know, any savings that comes from this just gets recirculated among rural companies. It doesn't leave the pot, right?
Yeah, good point that, hey, we're not reducing the amount of support available to companies. It's just the size of the pie is the same. It's just everyone's slice of the pie is going to be a little bit different.
Right. I mean, in every aspect where they're cutting individual carrier support, whether it's because of the lower rate of return, whether it's because of this competitive overlap, whether it's because of the operational expense limitation, that money then just gets recirculated and the $2 billion budget remains the same. So it's just moving money among rural companies. But anyway, going back to my back-of-the-envelope calculation, the FCC estimates that their preliminary estimate based on Form 477 data is that there's 20% of all rate of return carrier census blocks that show competition, qualifying competition, based on Form 477 data. Now, Form 477 data is when people file those, you only have to have one customer in a census block, and the rules are for Form 477 is you identify that as a census block you're serving. Now, for purposes of this rule, you have to be serving 85% of the locations in a census block in order for it to qualify as a competitive census block. So let's say of the 20% of rate of return carrier census blocks, 20% of the, and this is probably a way overestimate, but I'm trying to be as conservative as possible. Let's say 20% of those census blocks, 20% of the 20% actually have 85% of the locations being served by those qualifying competitors, and those qualifying competitors take the time to actually file saying that they're serving 85%. Now you're down to only 4% of rate of return carrier census blocks, and that doesn't equate to 4% of support, because we know that's going to, for the most part, be the lower cost census blocks. So let's say those 4% of census blocks, now maybe it equates to 1% of rate of return carrier support in aggregate total. And that's probably, and I think I'm overestimating. I think it's going to be less than that.
Right, and so I think it's an interesting calculation. I appreciate Stuart walking through it. Certainly within that 1% in total, there could be companies that are impacted significantly.
Sure.
And companies who are not impacted at all or nominally impacted. But we think in total it's not going to have a huge impact on any individual company's support.
I think this whole thing, it's about public accountability and optics. I think it's about the, FCC showing that the fund is accountable to the public in the sense that they're not funding an area where, it's able to be served without any support at all. And just from a public accountability standpoint, they need to go through this exercise. But I don't think it's going to amount to very much at all.
Okay, great. A couple of additional questions, try to work through these quickly and wrap things up. The next question is, does fixed broadband include wireless? It includes fixed wireless, but not mobile wireless. Next question is, with regard to competitors, what is the time frame for the Wireline Competition Bureau to provide this list of competitors by census block? It doesn't specify an exact date, but it can happen quickly. They already have this information available. It comes out of the ACAM. It comes out of the FCC Form 477. So we already have that list generally available. The FCC will likely produce it shortly after the order is effective. So I think the order becomes effective 30 days after publication in the Federal Register. So I'm just guessing sometime in the next 60 to 90 days. Stuart or Tim, any additional thoughts as to?
I'm sorry, is this on this whole, are we talking about the timing of the competitive census block challenge process?
Yeah, so when will the Wireline Competition Bureau publish that preliminary list?
Here's what I can tell you. I don't know when they're going to publish the preliminary list, but the challenge process itself requires OMB approval, and that's not going to be for a while. So I would estimate, and I believe the FCC has indicated this, that they don't estimate this challenge process occurring until probably late this year, I would say fourth quarter, and it won't affect support calculations until first quarter 2017 at the earliest.
Right. So that wouldn't preclude Wireline Competition Bureau from issuing the list sooner than later, but
I think
the process is going to take its time.
Right. Okay, yeah. It's just in terms of, yeah, they could, certainly their prerogative to preliminary, let carriers know where preliminary the competitive census blocks, but the challenge process won't occur for quite a while.
Sure. Okay. Just a couple of comments that have come in here related to standalone voice offerings by cable providers. Have gotten some indications that others elsewhere do have the availability of standalone voice via cable providers. It can be pretty expensive, but it does exist. So, final written question that we've got here, and certainly if others come in, we'll get to those while we're answering this one. If the FCC does not provide data for these disaggregation options, where would the data be obtained? All of it's going to come from publicly available information. It's going to come from the FCC Form 477 data. It'll come out of the ACAM. The FCC is going to publish the list of competitive census blocks, square mileage. We can get information on census blocks that are competitive. There's publicly available data on the square mileage of census blocks. I know we've already started doing some calculations behind this by gathering publicly available information. Not suggesting that it's simple, but the information will be available to you. And again, it's just my belief that I don't think that the FCC is going to provide those calculations, and I don't believe that they're going to direct NECA or USAC to perform those calculations. I could be wrong there. So, an additional comment just came in, and it's a good one. I appreciate someone weighing in with this, that the FCC, I guess they had an hour-and-a-half webcast that somehow they condensed to an hour yesterday. Somehow I can't keep a 2-hour webcast to less than 2 hours and 15 minutes. So I don't know how they did the entire order in 1 hour when I'm going to clearly be at 6 or more for the entire order this week. So anyhow, what we're hearing is that in the FCC's webcast yesterday that they plan to release the list of competitive census blocks by the end of this week. So that's pretty quick. And then the additional comment is to complete the 21-day challenge process that's associated with the ACAM, not with rate of return. That 21-day challenge process could presumably then be concluded by the end of this month. So interesting information. I appreciate you weighing in with that because it's always helpful to share that good information. So I don't see any additional written questions at this point. So on that note, I'm going to sort of close things out. So I wanted to thank everyone for their participation in today's webcast. Really hope that this information that we provided yesterday and today and will continue to provide on Thursday's webcast. So no webcast tomorrow. Thursday morning, we'll have the third in our series of webcasts. That'll be held at 8:30 a.m. Pacific time, Thursday morning. And we're going to focus in on several different items, cost limitations, so operating expenses, CapEx limitations, reporting requirements that are new or come along with this new order. I'm going to talk about rate of return represcription and how that's going to transition downward from the current 11.25% rate of return. And then we're going to focus in on the further notice of proposed rulemaking that's associated with this order that asks a lot of questions about other things that may still need to be done and that could impact these modifications that were just made, may layer on top of those. Also want to encourage people, please don't forget to register for the Moss Adams Management Conference. I know I probably sound like a broken record here. Confident it's going to be a great session. Encourage you to attend May 3rd and 4th in Las Vegas. If you have any questions, need to know how to register, please let us know. If you have any additional questions on USF reform, any other topic, anything we covered today, anything we covered yesterday, whatever you want to talk about, please contact any of today's presenters. Stuart's and my contact information is here only because, this is stuff that we're focusing on all the time. Certainly Tim has been a valuable contributor to the webcast, very knowledgeable resource. Reach out to him as well, or whomever at Moss Adams that you work with or are comfortable with. So we're going to now bring this webcast to an end and open the lines up for a brief live question and answer session. So please have a great Tuesday. We hope to see you again on Thursday. Thank you.